So, good afternoon from London to everyone, whatever their time of day, to everyone who's joined us in such large numbers from all over the world, Europe, MENA, Asia Pacific, Africa, the Americas. I am Stuart MacDonald, and I am delighted to moderate this timely and authoritative webinar. It is the latest in the distributed ledger technology, or DLT, and crypto assets investment specialists' Era Capital's thought leadership series of educational webinars. The last Era webinar but once focused specifically on non-fungible tokens. This one is going to be looking at crypto assets, inflation hedge, portfolio diversifier, or return enhancer. Ultimately, it's about understanding their place, their role in a well-managed portfolio. To help us, we have two expert voices. We have Peter Habermacher, co-founder and chief executive officer of Era Capital, plus renowned economist, Professor Giovanni Rico of the University of Warwick, who acts as one of Era Capital's expert academic advisors. Now, before we start with Professor Rico's presentation, we all know that the broad DLT, or distributed ledger technology, growth story is at the heart of the economy of the future, and one which is full of both immediate and long-term investment opportunities, whether around the proliferating applications of blockchain and analogous technologies, decentralized finance or DeFi, NFTs, crypto assets, including tokenization and cryptocurrencies. Era's thesis is that together, especially if this is done in a carefully risk-controlled manner, these developments present potential return patterns with strong upside potential and returns that are notably uncorrelated with other investments, whether traditional equities or bonds or alternatives like hedge funds. Now, the Era Capital Thought Leadership webinars are designed for professionals in the investment space to learn more about this fast-growing, often complex and fast-maturing area, still often misunderstood, but attracting serious investment interest from serious players like Fidelity, Goldman Sachs, Andreessen Horowitz, Bank of America, from sovereign wealth funds to some of the most respected family offices and investment advisors around the world. And Era Capital is the first player, to my knowledge, with a truly institutional quality, multi-manager, multi-strategy approach to it. This is a very research-intensive as well as structured approach, and I think you'll agree that it is reflected in the tone of these sessions, which are intended to be sober, thoughtful, and informative, without hype. Now, if you want to learn more about all of this after the webinar, Era's contact details will be at the end. More immediately, if you have questions for the speakers as we go along, please put them into the chat section. The earlier in the presentations, the better. We will try to address them in the time available. Now, here is the substance as I invite Giovanni Rico to take center stage. Giovanni.
Hi, Stuart. Thanks for your very generous words. Let me share my slides before we start having a chat about what, as you were saying, a very topical question, namely what is happening to inflation today, and whether there is a role for crypto assets as an inflation hedge. So let me start just by remind ourselves what we call, and these are clearly things, working. What is inflation, and why we are thinking so much about inflation at the moment. Now, very simply, the rate of inflation, as we all know, is the change in prices for goods and services over time. And this is clearly a very abstract concept and is captured by several indicators, as for example, the consumer price index. All of these indicators have underlying the definition of a basket of goods and services that should capture, to some extent, the consumption patterns of the average, let's say, a consumer in the economy. And here I'm just showing you some time series for two indicators of prices, the consumer price index, the headline inflation, in other words, and what is called sometimes core inflation. It is headline inflation stripped of food and energy prices. And I'm showing them in inflation terms, that is in change in terms, as per 1 year ago. And this is a long series from the 1950s. And of course, as we all can see on this chart, the last few years have seen fairly low inflation rates. However, as we all know, just by looking at news or just by looking at prices in supermarket at this point, things are changing apparently. And in fact, in US, but also in UK, where we live, or in Europe, inflation has been going up steadily, not just the headline inflation, but also core inflation. And in fact, for example, in US, the last reading for headline inflation was 6.8. This is a fairly high reading as compared to the historical average of the last 10 or 20 years, but also above what is the official target of the Fed, that will be a 2% inflation rate. So it's a very intense debate. I will try and say something more later about what are the sources of this increase in inflation, but also there's an intense interest at the moment on how consumers or investors could and should hedge against a potentially higher level of inflation going forward. And in fact, in the crypto space, as again, probably we all know, Bitcoin traded at $69,000 last Wednesday in response to the US inflation news release. And that was the highest price at which Bitcoin has been traded, but also was potentially the first time in which there was a clear sign that Bitcoin was traded as a store value asset in response to economic data and potentially as an inflation hedge asset. So what I'll want to do next, what I want to do today with you, is to review some of the arguments in this debate on why Bitcoins and crypto could be an inflation hedge, and assess their consistency, and then perhaps talk about what is going on with inflation and what could happen in the future in the space of crypto currencies and inflation. So let me start just by reminding ourselves what is an inflation hedge. And as we know, inflation hedge and inflation hedge is an asset that provides protection against inflation. And it does so by having a positive correlation with inflation rates. That is, when the inflation rate goes up, that asset price will go up. And of course, a perfect asset would have correlation 1, and in particular would have correlation 1 with inflation surprises. Now, as we know, historically, gold has been considered the inflation hedge. And the reasons for that is that when we look at the 70s and the 80s, we can see that there were both very strong gold returns, but also extremely high rate of inflation. However, and that's probably it's worth underlining, historically, there's been fairly weak correlation between gold and returns on gold and inflation. And you can see that in this chart, where probably you can spot moments in which relatively high inflation rates or spikes in inflation were matched by relatively high returns in gold, and that was happening sometimes during crisis. But otherwise, if you look at the general sort of the structure of this time series, you would observe that there's a fairly low correlation in normal periods. So the debate on Bitcoins and inflation kind of rotates around the question whether Bitcoin and more generally crypto assets can be the ultimate inflation hedge. And in fact, here I'm just borrowing from the Bitcoin Standard, the book of Amos, where he says that Bitcoin can be best understood as a distributed software that allows for transfer of value using a currency protected from unexpected inflation without relying on relying on trusted third parties. So clearly here, inflation is important. It's one of the key property of the Bitcoin, has per this quote. And the question is why? And what I want to do next is try and unpick a bit what is kind of hidden in this sentence, and try and understand what are the possible arguments we can propose on why Bitcoin should be an inflation hedge or could be an inflation hedge. Now, there are three main arguments, and I would say 3+1. There's kind of a little addendum to the second of these three arguments. So let me review them with you. The first one is that Bitcoin is by design a currency similar to the old gold standard currencies that were pegged against the gold. And in fact, it has a fixed supply that cannot be debased, and therefore is safe from monetization, manipulation from governments. And in fact, it has been engineered to be scarce, as gold is scarce, against an expanding economy potentially. And therefore, it should be deflationary by nature. It should appreciate over time, or in other words, the price of a given basket of goods should decrease in Bitcoin terms over time. So that would be the first argument. I'm not sure this is an argument about why Bitcoin should be an inflation hedge, but I'll try and assess it with you. The second argument is that Bitcoin has high returns. These high returns are often in excess of the inflation rate, or for most of the history of Bitcoin have been in excess of the inflation rate, and therefore it offers protection from it. It's a very kind of simple, clear argument here. And there's an addendum to that, and it's the idea that CPI is indeed a misleading measure of inflation. And in fact, if, for example, as people would say, and you see this argument often in blogs, if you are a wealthy investor, then your inflation rate is not the common inflation rate, the headline CPI, but instead should be adjusted to include assets and services you want to acquire, for example, real estate or other assets. And those assets have been appreciating strongly with in excess sometimes of 20% in the last few years. So if you just look at CPI, that will be a misleading number. The third argument is that Bitcoin should and will substitute gold as an inflation hedge because they have similar property of gold, but on top of that, they offer lower storage and transaction costs. So let me now move through these three arguments and see how they stand on their own merits. And then perhaps I'll add a couple of notes. So the idea of cryptocurrencies as currencies that have an inbuilt ability not to generate inflation comes in a way from the Austrian view of money that is very popular in the crypto space. And that goes back, if you want, to Hayek's denationalization of money, the old book of the 76, where the point he was making, where first of all, that governments should lose the monopoly over money. And the reason is that they are too prone to recurrent mismanagement. And in fact, inflation happens due to debasement, and especially in the case of fiat money, governments and central banks have a constant temptation to debase their currencies. And instead of government or public money, there should be a market for competing private monies as unit of accounts and store of value. And therefore, the currencies that have better properties in terms of unit of accounts and store of value will prevail in this market. Now, Bitcoins and other cryptos, people will say, with their fixed supply, offer store value and ease of transaction, and therefore they have ideal money properties. Now, what are the fundamental issues with this vision, or some of the problematic points of this vision? First of all, scarcity and decentralization do not guarantee protection from inflation. They just guarantee that there is no central authority that can debase coin or that can debase crypto assets. However, Bitcoin value, as for any other crypto assets value, depends entirely on the willingness of consumers and investors to hold it, and therefore is based on the trust that people have in them. It's not tied to any other assets that rises in value along with consumer prices. So in a way, they don't offer, at least following this argument, protection from inflation, and they are prone, if you want, to break down trust potentially that would drive the value to zero. And in fact, as we know, historically, private monies are fragile. And that's a recurrent fact in the history of private monies. So the second argument is about high rates of returns as compared to potentially high inflation. And again, let me recap. The idea is that very high returns in cryptos offer good inflation hedge properties. And on top of that, and that's an important fact that I don't want to discount because I believe it's true, cryptocurrencies are traded and stored with ease, and this, in a way, allows them to be potentially more efficient as an inflation hedge as compared to other assets, in particular gold. However, there are potential issues with this vision. First of all, to be an inflation hedge, an asset must correlate with unexpected changes in inflation and inflation surprises. I will talk about this more in a second. Cryptocurrency have high volatility at the moment, and this is not a desirable property for an hedge. They seem to be exposed to similar macroeconomic factors as traditional assets, and this would reduce potentially the effectiveness as an hedge. However, as compared to other assets that could offer, for example, stocks, some inflation hedge property due to the fact that they will factor in forward expectation in terms of prices and dividends, crypto assets might offer a more opaque signal on supply and demand factors. So that's on the second argument. So let me assess in a way that little addendum I was mentioning on CPI. Now, the idea here is that CPI does not fully account for inflation as perceived by people, and in particular, if you are a wealthy investor, that will not account for your desired assets. And some of these assets have had large price increases over the last few years. Now here, the source of confusion is the difference between asset prices appreciation and inflation. These are two different concepts. The first refers to changes to market value of assets we buy as an investment, that is, to earn future income. The second is about the price of goods and services we want to acquire for consumption, to be enjoyed. Now, in fact, statistical agencies explicitly exclude from inflation all changes in the values of investment assets, for example, real estate, bonds, but also gold or bitcoins. And in fact, by doing that, they try and make sure not to mix consumption and investment goods, because these are two different categories that are, in a way, thought on different horizon and for different purposes. So the last argument is whether inflation expectation and crypto might correlate. And this is crucial because in order for crypto assets, in particular Bitcoin, to take the role of gold or other inflation hedge, they have to correlate somehow with inflation expectation and inflation surprises. Now, of course, the problem in assessing whether they correlate or not is that we have fairly short time series for cryptos and for Bitcoins. Here, I'm showing from a recent paper of Colon, Corbett, and McGee on Economic Letters 2021, two plots of the 5-year forward inflation expectation rate as computed by the Fed against the log of Bitcoin prices and the log of Ethereum prices. Now, as you can see, the correlation doesn't seem to be super strong or perhaps super stable, but what they've done in this paper and what you could do is to do some sort of rolling window exercise. What they do, in fact, is some very sophisticated rolling window exercise that is done with wavelets, and they look for coherence in the wavelet space. This they look for some measure of time varying correlation, if you want, across periods of time, across the samples, but also a different lag lengths in a way, whether perhaps Bitcoin prices correlate with inflation expectations at 4 days, 16 days, or longer. And you see these two measures in the axis. So essentially, the y-axis will give you the correlation period in days, and on the x-axis, you see the evolution in time of the properties of these assets. And as you can see, generally, the blue is dominating. Blue means very low correlation, very low coherence. So in general, that does not seem to be a lot going on. However, if you look at the more recent sample, in particular during COVID, you see there's some nice red area above 16 days delay. And that might be an indication that during COVID, with large shocks, there is an increase in the correlation. Now, let me conclude just by discussing here in terms of macroeconomists, how large are the inflation risks at the moment for the US and Euro area, and perhaps for the UK. And here I'm borrowing from a model that I've been contributing in developing at Nowcasting Economics. On the left is the Euro area, on the right is the US. The data for the UK, as far as I understand, are similar to the US. And there are two things you can see. This is a quite sophisticated model that allows us to decompose movements in inflation into structural components, if you want. What is due to the business cycle via Phillips curve relationship, and what is due to energy prices plus some residual components. The blue component is the business cycle, the red energy prices, the yellow is an idiosyncratic component or a residual. Now, there are two things that are worth appreciating. The first is that if you look at the forecast part, and that will be the top charts for Euro area and CPI, there is a fairly high point at the moment, but there is a forecast of a descending path of inflation, and that descending path is also captured by inflation swap, a market implied prediction. So the markets and the model are fairly in line for the case of the Euro area, while markets forecast a higher rate, even though in descending rate of inflation for the US. So there is higher risk of inflation, I would say, in the case of US, relatively lower for the Euro area. In Euro area, we seem to be going back to target. But when we look at the decomposition, that will be the lower component. You see that the red kind of part dominates. So this is largely due to energy price shocks. As we know, energy prices are particularly high. This is affecting, of course, headline inflation, but also is increasingly affecting core inflation. And there is a kind of a deeper question here that these models do not capture, and is whether, consistent higher inflation than the target might induce a disanchoring of expectation, and that would imply very high rates of inflation going forward. So that's the very actual risk we are discussing at the moment. However, on balance, inflation seems to be still relatively anchored, and therefore it's on the central bank to kind of assess the risks and make sure that they bring inflation back to the target. So let me conclude. So I've been trying to cover lots of ground, and perhaps we can discuss more during the questions. But my view, looking at the literature and looking at the data, is that there's historically, when we look at Bitcoins and other crypto assets, there's high volatility, and there's a very relatively low correlation with inflation. That would sort of caution us against the property of Bitcoin as an inflation hedge. And in fact, it's likely that crypto assets have to be thought of as more in terms of a risk-on asset, that is an indicator of risk appetite, where investors might converge in order to have high returns and potentially portfolio differentiation, a property rather than a safe haven asset property. However, just by looking at the data on Wednesday, well, we know that was potentially the first time when Bitcoins directly responded to US inflation data and behaved in a way as a store value asset. So the question is, what will happen going forward? We don't know. So it's possible that a sharp rise in inflation in the future will induce a movement towards Bitcoin, and Bitcoins will take the role of gold, and therefore that will increase correlation going forwards between inflation and Bitcoin prices, but also might have the opposite effect. And in fact, sort of the scenario you might want to consider is the scenario in which, for example, higher inflation is associated with a supply shock. Oil shocks are notoriously supply shocks and potentially recession. And in such case, investors might as well react by offloading risky assets and moving into lower volatility assets. That case will generate lower correlation. So whether we are in one case or the other, we don't know. Much will depend on how markets will perceive Bitcoins and crypto assets and how expectation forwards will form. I shall stop here. Thanks a lot for your attention so far.
Well, thank you, Giovanni. That was thought-provoking, excellent stuff. A number of questions have come in, which I'll try to bundle together almost as though they are one, and it's really up to you in the 3 or 4 minutes remaining to see, how you want to answer them. One is, how likely is it that unconventional monetary policy and fiscal stimulus end up debasing the value of the main fiat currencies, the dollar, the pound, the euro, the yen? Equally, do you expect ultimately, in spite of the perhaps conflicting indications, do you expect Bitcoin ultimately to acquire a safe haven asset status in the future? And another question is, would stable coins offer a better inflation hedge? Over to you.
Well, those are really important questions. On the first, so central banks have been using unconventional monetary policy since actually one from the last recession, the great financial crisis, and there was a massive expansion of liquidity. As we know, however, inflation barely moved. That's because central banks managed to stabilize expectation of agents going forward, in the sense that agents were expecting central banks to be fully committed to their targets. Now, the question is whether we are entering a new world post-pandemic where inflation expectation might be disanchored, and given the very high level of public spending, agents might start thinking that a debasement or a monetization, as it's more correct to say, could become likely. So in a way, that will really depend on how central banks, but also government, will be able to communicate their path, the policy path moving forwards, and whether they're willing and able to stand by the official inflation target, and in the case of the fiscal authority, whether they will be able to rise, let's say, taxes in order to repay for the very large debt that has been accumulated in the last year or so. That was on the first question. On the second question, I really don't know. That's a very important question, but I think really will depend on how investors and consumers will, in a way, incorporate crypto assets in their investment opportunities. And there are two very different scenarios. One in which we keep having them as, in a way, as I was trying to say, risk-on assets that we look for high returns in moments in which we seek sort of more risk in our investment strategy, or whether we start looking at them more as safe assets. Whether one or the other view will prevail will much depend on what will happen in the space, for example, of other assets, but also on whether we will be able to have lower volatility going forwards, let's say, in the crypto space. And in general, the market will be more established with kind of larger players. So I really don't know. It will depend crucially on what will happen next. So the last question, could you repeat that? I'm sorry. Stuart, sorry.
I'm sorry, would stable coins offer better inflation hedge?
Oh yeah, sorry. Yeah, so that's another really interesting question. I would say they will, and probably they'll offer lower volatility. I mean, that will be an important sort of property for inflation hedge. However, whether they offer inflation hedge properties or not will depend on what they are pegged against. If they are pegged against the dollar, clearly they will move as the dollar. If they're pegged against a basket of currencies or assets, then they might have very low volatility and might have potentially better property. But yes, that's again an important question. It will depend on the details of the implementation of stable coins. Thanks a lot. Thanks a lot.
No, thank you, Giovanni. One only wishes there was more time, but it marches on. Again, thank you. Now, let's pass the baton now to ERA's co-founder and chief executive, Peter Habermacher. Let me remind the audience, if you have questions for Peter as we go along, please put them into the chat section. The earlier in the presentation, the better. Now, without further ado, over to you, Peter.
Thank you, Stuart. So, hello everyone, my name is Peter Habermacher and I'm delighted to be the Chief Executive of Aro Capital. So, if Bitcoin is not a reliable inflation hedge, why invest in DLT and crypto assets? First and foremost, from an economics perspective, DLT and crypto assets offers an attractive long-term growth opportunity. This is at a time when there is increased uncertainty amongst other asset classes, which have become increasingly detached from economic fundamentals and reliant on expansionary monetary policy. Second, this technology has the potential to disrupt virtually every industry and has applications of many different value chains. Third, this asset class has been the fastest growing, highest returning asset class, both on an absolute and risk-adjusted basis. We believe that it still has a long way to go. In spite of their volatility, crypto assets can offer superior risk-adjusted returns when compared to other asset classes. The Sharpe ratio of crypto assets over the past 6 years is far above those of other asset classes. Fourth, crypto assets are uncorrelated to other asset classes with correlations of close to zero across the board and are even low even during times of crisis in traditional markets. This makes crypto interesting when it comes to portfolio diversification, especially given that most other asset classes have moved together over the past few years. Fifth, well-known industry names are embracing this new technology. What makes the DLT story so powerful is the clear economic value that can be generated through its adoption. For crypto assets, nearly 90% of institutional investors now find something appealing about them. They are uncorrelated to other asset classes, are an innovative technology play, and have high potential upside. Many top-tier institutions have already invested in the crypto asset market, adding liquidity and helping institutionalize the sector. Finally, established investment and operational risk management practices can be applied successfully to this asset class. The market is maturing and is becoming much more professional than in its earliest days. So what is the impact of adding DLT and crypto assets to an investment portfolio? The first key observation of this analysis is the outperformance of crypto funds relative to the crypto market overall. Secondly, and this may surprise many, is that there is empirical evidence that to get the most out of an allocation in this space, one should allocate up to 5% of a portfolio to DLT and crypto assets. As can be seen on this slide, a 5% allocation of crypto funds to a traditional portfolio can improve returns substantially, but the volatility stays virtually the same. How and why is crypto a valuable investment? What is the value of holding crypto as an investment asset if it does not directly generate cash flows like stocks, bonds, or property? A similar debate has been between those for and against investment gold and other precious metals as they developed into established alternative asset classes. How does crypto translate into real returns for investors and not just a case of offloading it onto the next buyer? Firstly, Bitcoin and other cryptocurrencies can now be used to generate yield via staking in decentralized finance protocols, similar to the interest earned in a bank account, although the yields in decentralized finance are far higher. Second, cryptocurrencies are uncorrelated to other asset classes. The more uncorrelated assets one adds to a portfolio, the higher return one can get without taking additional risk. Studies by Yale and Van Eck show empirically that just by buying and holding cryptocurrencies can indeed do this. Getting high returns without taking more risk is essentially what we pay asset managers large fees for. For uncorrelated assets, instead of paying an asset manager on an ongoing basis, one instead pays a premium in the price of the asset for this benefit. Finally, and most importantly, many still view cryptocurrencies as just a currency like fiat money, but in reality, they are much, much more. Crypto is a next generation value-based internet, as HTTP and HTML are the platform of the World Wide Web. Ethereum and other crypto networks are the platforms of Web 3.0. In the same way that the web today enables many services, software built on Web 3.0 is already providing a wide range of valuable services to consumers. Through clever economic design and game theory, the long-term value of a cryptocurrency will increase as the value of the internet services provided on the crypto platform grows. There's a similar appreciation effect on a national currency when there is strong economic growth. This is also, in some senses, analogous to Amazon shares increasing in value as more people use the Amazon online marketplace. However, as explained in detail in previous webinars, the revolution of crypto can enable many existing internet services to be provided faster, better, and cheaper by decentralization, removing the need for expensive middlemen and network monopolies such as Amazon, Meta, and Alphabet. What are the key portfolio considerations for DLT in crypto? As an investor, the focus always needs to be on the portfolio's core investment aims. This is done by optimizing the key performance metrics such as annualized return, Sharpe ratio, Sortino ratio, or maximum drawdown. From modern portfolio theory, the aim of any portfolio is to maximize return for a given level of risk, specifically downside risk. The aim is to get as close as possible to the efficient portfolio frontier where one is maximize return for a given level of downside risk, which we as an investor are willing to take. The key decision when constructing a portfolio is the level of active management to take. However, there is an important trade-off, namely, the more actively managed a portfolio is, the more alpha generation is possible and the closer one can get to the efficient portfolio frontier. However, if done incorrectly, active management greatly increases the likelihood of underperformance or excessive levels of risk. The practical constraint on how actively managed a portfolio is the available time, resources, and expertise. To do active management effectively requires a lot of time and it is expensive. Further, the investment horizon of a portfolio is a key consideration. Finally, The key to effective portfolio management is understanding how each allocation works together to achieve the investment aims. It is not just about chasing investments with a high Sharpe ratio or other key performance metric. There are three components, or three common approaches to portfolio construction: the core approach, the core and satellite approach, and the building blocks approach. The core approach is simple, cheap, and straightforward to implement and monitor. This should be the go-to approach in markets where one has limited expertise. In the core and satellite approach, one is able to enhance core portfolio allocations with niche opportunities. However, this requires more time, resources, and expertise. In the building blocks approach, one has full flexibility in portfolio construction and the ability to fully express one's investment views. There is the potential for large alpha generation. However, it is complex, requires time, it requires resources, and it is expensive. For this reason, the cost-benefit ratio of initial allocation via this route can be high. Our uses the building blocks approach to be able to fully utilize our in-depth understanding of this technology and asset class. This enables us to more effectively manage risk while being able to capture more of the upside in bull markets. Diversifying into a new asset class can bring diversification benefits, but also presents potential challenges. When diversifying into a new asset classes, many investors commit the cardinal error of relying excessively on past performance to optimize portfolio allocations. In contrast, the most successful investors focus on expected future returns, which require much more detailed understanding of the investment opportunity. Every asset class is distinct from others, and investment strategies need to be tailored to the specific characteristics of each one. Investors should always seek to develop and adopt the investment philosophy which will maximize the portfolio benefits of any new asset class. The DLT and crypto asset opportunity is truly unique and therefore requires a bespoke investment approach. The crypto space is full of competitive opportunities. Many investors who enter it, however, cling to their favorite investment strategies without discovering if it is genuinely the best approach. Sensible investors should always gain a broad understanding of the crypto investment landscape before making a meaningful allocation. Regrettably, many pay the price for failing to do so. A key component of RO's investment approach is encapsulated by the famous quote from Harry Markowitz: "Diversification is the only free lunch in finance." Studies by Yan and Van Eck show empirically the portfolio diversification benefits of crypto assets. A working paper co-authored by one of our economic advisors, Dr. Daniela Bonacci of Queen Mary, University of London, suggests that there are diversification benefits from investing in a larger range of crypto assets beyond just Bitcoin. Further, RO's analysis suggests that diversification benefits that beat buy and hold strategies are possible via blending different investment strategies in this space. What is the best way to invest in DLT and crypto assets? There are various ways for professional investors to access the DLT and crypto asset growth story. The real challenge is being able to gain exposure in a properly risk-managed and dependable way. We are arguably at the same stage of market development as hedge funds were in the 1990s. Rather like then, investors who are less familiar with this space should consider a dedicated fund of funds managed by specialists in this area. This can provide access to the full range of opportunities without the pitfalls. So on the DLT side, it can be difficult to access the top deals and VC funds and long lockups, whilst blockchain ETFs can give pure and over-concentrated exposures. Equally on the crypto side, direct investment requires a lot of time, resources and expertise, and there are operational challenges, whilst pure Bitcoin funds and passive indexes can carry concentration risks. with little downside protection. Actively managed funds need thorough due diligence and have widely dispersed results. The potential for outsized risk-adjusted returns from effective active management is an order of magnitude larger than in traditional asset classes. One can see this when comparing the outperformance of crypto funds relative to passive benchmarks. Our economic advisor, Dr. Daniele Bonacci of Queen Mary University of London, has co-authored a working paper on the performance of crypto funds and found that they notably outperformed. On average, active crypto funds have notably outperformed both Bitcoin and the wider crypto market over the past 6 years, with a third less volatility and half the maximum drawdown. The best strategies based on diversified allocations have performed even better. However, there is a large dispersion in crypto managers' performance. As the paper on crypto funds found, only a minority of funds can outperform passive benchmarks and produce large and economically significant alphas. There is also a large dispersion in the risk-adjusted returns with managers with no clear relationship between risk and reward. Importantly for active investors, the paper also suggests that manager relative performance is persistent over time. Crypto manager performance is not mean reverting, and so we are convinced that effective manager selection is essential to achieving superior performance. There is a very broad and diverse set of opportunities in the DLT and the crypto asset growth story. There are over 400 crypto hedge funds, over 400 blockchain and venture capital and private equity funds, several hundred exchange traded products, including ETPs and exchange traded notes, some structured products such as actively managed certificates, and an increasing number of equity funds such as blockchain ETFs, as well as crypto investment trusts. The DLT and crypto asset management industry is now estimated to have over $100 billion in assets under management. Alongside traditional fund structures, there are also hybrid funds, which provide access to VC-style investments through open-ended hedge fund structures. The key aim of DLT and crypto is open finance, allowing greater access to investment opportunities and to also improve the secondary markets for venture capital, private equity investments. It is these developments which allow for the shorter investment horizons of these hybrid funds relative to traditional VC. Every investment strategy within the realms of traditional finance, from market neutral arbitrage to long short trading to VC to fixed income, also operates within this new asset class. They are, however, distinct in many ways from their cousins in traditional finance. Our has developed a comprehensive methodology to categorize all of these strategies based on portfolio construction considerations. We split the strategy landscape into 3 macro buckets: non-directional, trading, and long-term. Non-directional strategies focus on capturing the short-term inefficiencies in crypto assets through arbitrage or opportunistic approaches. Arbitrage could be trading spot against spots, spot against futures or options, or taking advantage of the demand for liquidity in the markets. Opportunistic approaches are much more crypto-specific, such as lending, hedged farming, staking, or mining to generate some yield. Usually, these strategies focus on the most liquid crypto assets. Generally speaking, these strategies generate around 20 to 40% per year with a good Sharpe ratio and very shallow drawdowns. They are good at protecting portfolios during weaker market environments. Trading funds focus on timing the markets, taking on market risk to get higher returns, whilst managing some of the short-term market volatility. Trading strategies can have different levels of market exposure and can be either systematic or discretionary. Common trading strategies include trend following, mean reversion, relative value, alongside many other niche strategies. Different strategies focus on different data, for example, technical analysis, sentiment, or so-called on-chain data. As public blockchains are transparent, on-chain data gives an unprecedented level of visibility on the buyers and users in the market and their activities. These strategies tend to focus on the top 10 or 20 crypto assets due to liquidity. In terms of returns, generally these strategies capture a good chunk of the market upside with reduced volatility, a good Sharpe ratio, and modest drawdowns relative to the wider crypto market. Long-term strategies include both active and passive approaches. We focus on the active side, which includes fundamental, thesis-driven investing in public and private tokens and equities. Long-term also includes special situation trades, as well as unhedged yield-enhancing trades. These strategies often invest well beyond the top 100 crypto assets. They look at public equities and also look at early-stage unlisted tokens and private equity. Long-term strategies generally offer a large amount of upside, often beating the markets, but also high volatility. This results in a Sharpe ratio, lower Sharpe ratio, a more pronounced drawdown, but ultimately higher returns. Individually, these macro buckets offer exposure to various subsets of the market, but in combination, they form a more balanced approach to this growth story. One can enhance the key performance metrics by rotating between different strategies depending on the market outlook. In a bull market, more long-term and high beta trading exposure will enhance returns, whilst in bear markets, non-directional and low beta trading will protect the portfolio. This is what we do at Aro with our own portfolio. In summary, we believe that there are some really exciting opportunities to generate outsized and sustainable returns in this market, both over long and short term. DLT and crypto assets are an efficient portfolio diversifier and can substantially improve the overall investment portfolio's absolute and risk-adjusted returns. We believe that an active fund approach makes sense and that the best way to approach things is to professionally manage fund of funds. Thank you everyone for listening.
Well, Peter, thank you very much for that. We have just over 5 minutes left, and it's welcome that we've had a number of questions arising from what you've been talking about, and also some from the audience. I'm going to give them to you in stages. One of them is, what are the advantages, as you see them, of investing in a DLT and crypto asset fund of funds, as opposed to the other ways of accessing the growth potential in this space? And associated with that, another question: why diversify beyond just a market neutral crypto strategy?
There is a shortage of widely available information about the funds and other vehicles in this space. We speak to a continuous flow of new managers every month, much of which necessarily comes from within our own network. Many of the best managers cannot be found off the page. There are 3 key advantages to a fund of funds approach to the DLT and crypto asset growth story. First, provide access and broad exposure to the expertise of active managers specializing in different areas of this diverse set of opportunities. Also, the aggregation of capital enables the high minimum investments of the top funds to be met and allows for negotiation for better terms and fees. Second, portfolio diversification across asset class, style, strategy, and fund structure can provide an effective balance between risk and rewards. Diversification also reduces counterparty risk across multiple managers, exchanges, custodians, and other service providers. The third key advantage is specialist expertise. There is a dedicated team conducting in-depth investment and operational due diligence. Active portfolio management allows for navigation of the fast-moving market conditions in this space as well. terms of your second question on why to diversify beyond a market neutral strategy, so our research shows that there are much greater portfolio diversification benefits from including many different DLT and crypto asset investment strategies beyond just market neutral strategies. In crypto, large market moves and bear markets can also adversely affect market neutral strategies. So there's still some element of market risk present, and only having access to one investment strategy will adversely affect the portfolio sooner or later. Also, crypto market neutral strategies are not a shortcut to crypto investing that may initially seem. If one wants to invest in a properly risk managed and dependable way, there are also many crypto-specific investment and operational risks which still require time to research, identify, and properly manage. One still also needs to understand the breadth of the crypto market neutral opportunity set, which, given the large information asymmetries in crypto, requires a large amount of research and the right network to access the top managers who often operate within closed networks. And finally, portfolio management is not just about maximum Sharpe ratio or the performance metric. Kind of as covered for modern portfolios, clearly the aim is to kind of maximize return for an accepted level of downside risk. And our analysis suggests that a 5% allocation to a balanced range of funds in a traditional portfolio can improve returns substantially, but and it will do this more than a similar allocation to market neutral funds in terms of increasing returns. And further, and rather counterintuitively, when adding kind of this broad set of funds to a traditional portfolio, volatility of said portfolio stays virtually the same, and its maximum drawdown even falls. This is due to crypto assets being uncorrelated to other asset classes, meaning that the volatility of crypto assets just makes it an efficient portfolio allocation. And this is why it is important to understand how different allocations within a portfolio work together to achieve investment aims, and not just to chase after investments with a higher Sharpe ratio or other performance metric.
Okay, and that's an interesting point about 5% being the point at which a portfolio would be optimized through the inclusion of crypto assets within it, because a lot of people, to use your term, counterintuitively, they wouldn't expect it to be quite that high. They might think, well, maybe it's 1%, but as you say, the research indicates that it's around 5%. But for all the talk about the undoubted lack of correlation between crypto and other asset classes, not just traditional ones, but also, let's call them traditional alternatives. These are low on average, but what about during a crisis?
Okay, so a working paper co-authored by Dr. Daniela Benacci suggests that the assets in this space are driven by forces other than factors that drive other assets, therefore can offer considerable diversification in bear markets and crises. And this can be seen in the COVID-19 pandemic, where the correlation between Bitcoin and traditional asset classes peaked at 0.5, whereas other asset classes had correlations around 0.9. And there are several academic studies that show that holding crypto during the COVID-19 pandemic did have meaningful portfolio diversification benefits, despite the initial shock to all asset classes due to the liquidity nature of the shock at the beginning of the pandemic, which was almost automatically cuts everything, has a negative impact on anything that isn't cash.
Okay, we have almost no time left, which is a shame. We've had a very good question from Johnny Fry, whom I know, who's the publisher of the excellent Digital Bytes, about whether we think that institutions will start yield farming their crypto holdings to generate additional yield in the current low interest rate environment. I don't think we have time for that. Equally, there's the question about the perennial question, how does one value crypto assets that's come in from someone else? But just in closing, as briefly as possible, let's address the ultimate question within this webinar, which is, do you see crypto assets as an inflation hedge, a portfolio diversifier, or as a return enhancer? Peter.
I see it as a portfolio diversifier and return enhancer.
Okay. More to be found out by any of the audience who wishes to contact Aero. If you do want to find out more, please do get in touch with Aero via their website or through your Aero contact. A recording of today's webinar will be circulated to attendees, as have the previous ones. And I just want to thank you, Peter, as well as Giovanni, for being so clear and highly informative. And I would recommend to the audience that the Aero Capital website contains an extensive library of informative white papers and shorter thought leadership pieces, well worth looking into. And I would encourage you also to look out for news of Aero Capital's next thought leadership webinar in the new year. You will all be welcome. And let me wish you all the joys of the season and a happy, healthy, and prosperous 2022.